Hi there, this is Kritesh and welcome to TradeBen's YouTube channel. In this video, we are going to discuss 7 ugly truths about stock market that you should know. First of all, if you are new to this channel, please subscribe. We publish new interesting investing videos every week. The stock market looks like a golden place to build wealth. There are a number of examples of popular stories of the ace investors in India and abroad who made tons of money by investing in stocks. However, alongside the pros, there are also many ugly truths about stock market which most successful investors, news channel and analysts ignore to discuss. In this video, we are going to review 7 such ugly truths about stock market which every retail investor should know. Let's get started. The first ugly truth is that no stock can give guaranteed returns. Even the bluest of the blue chips can underperform and not give any return for a sustained long period of time. There's a risk involved in any stock that you invest, no matter how much safe it may sound. There are thousands of reasons that may affect the share price of a company. For example, local and global economy, industry, company's fundamentals, technicals, new regulations, taxes, social and political risks, and many more. If anyone is giving you a guaranteed return promise, then either he is not experienced or he is just lying. In the stock market, the best you can do is to minimize the risk by taking calculated, informed decisions. However, no returns are guaranteed while investing in the stock market. There is a famous quote by Benjamin Graham: "Successful investing is not about avoiding risk but managing it." The second ugly truth is that greed and fear runs the market more than the company's actual performance. It is usual for the stock market investors to get caught up with greed and fear. When everything is doing well, good economy, high employment, government taking favorable decisions, etc., people become optimistic and somewhat greedy. After all, we all hope to make as much wealth as possible in the shortest amount of time, and this leads to mispricing of stocks. Because of the investor's excessive desire, that is greed, it becomes difficult to maintain a long-term strategy and stick to the fundamentals. On the other hand, when the things are bad, the economy is not doing well, and the market suffers a loss for a sustained long period, the people become excessive defensive. That is, they start believing that market and economy will continue to decline forever. This greed and fear drives the market and influences the decision of most of the stock investors. Although most gurus will not agree, the truth is that it's really tough to control your greed and fear to make a sound investment decision for a consistently longer period of time. The third ugly truth is that the corporate leaders may manipulate their earnings. Hate to say it, but yes, the corporate leaders may manipulate the earnings of a company. This is an ugly truth about stock market. Everyone wants to invest in a fast-growing company, and what can be a better sign of growth than consistently increasing earnings of a company? However, when the market starts expecting an extraordinary performance from the company quarter after quarter and year after year, it puts a lot of pressure on the corporate leaders to meet those expectations. And when they fail to do so, being afraid that their share price may fall down, sometimes they manipulate their results. There are a number of examples of the companies who were found guilty of manipulating their financial statements. The best example, which you might already know, is Satyam Computers. The next ugly truth is, would you pay rupees 1000 for a 1 liter packet of milk? Sounds stupid, right? But this is a common scenario in the stock market. Most of the people overpay to buy a hot stock and later end up losing money when the heat is gone. There are many companies who are trading at a valuation way higher than their price to earnings, even when they are not growing at a decent pace. Overpaying for purchasing premium stocks is a real ugly truth about stock market. Anyways, why do people overpay while purchasing stocks? The only time when you will be ready to pay rupees 1000 for a 1 liter packet of milk is when you don't know the real price, right? The same happens in the stock market. Most of the people do not know how to value stocks, how to read their financial statements, how to analyze a company, and that's why when they buy the stocks without doing a proper study, they end up overpaying for it. There's a famous quote by Philip Fisher: "Stock market is filled with individuals who know the price of everything but the value of nothing." For example, if you ask the price of any XYZ company to anyone, they can easily Google and tell you that it's currently trading at rupees 100. But if you ask what is the real price of the company, what is the value of a company, or at what price you should purchase that company, then most of the gurus and analysts will fail to answer that question. The fifth ugly truth is that over 90% of the people lose money in the stock market. This is the ugliest truth about stock market. Not everyone makes money from stocks, and the fact is that over 90% population loses the money in stock market. This is not because market doesn't give equal opportunity to all. Yes, I agree that for the high net worth individuals or investors, they have more resources and tools. However, the fact is that the market is fair to all the retail investors. All the informations are publicly available and everyone has the available resource to research and analyze the company. The only reason that most of the people lose money in the stock market is they are not ready to put time and efforts. Given an option A to research a company and invest intelligently, and B to invest in a rumored hot multi-bagger stock recommended by a friend or colleague, most of the people will choose the second option. Now let's move forward to the sixth ugly truth. It is that the herd mentality ruins everything in the stock market. An investor's natural instincts goes with the ones of masses, which means that he or she doesn't seem to have a rational view of a certain investment, but is more likely to deviate where the majority mass is moving. This little phenomena is known as herd mentality. For example, if there is a hot stock in which all of your friends and family has invested and is performing well, you are most likely intend to purchase that stock. However, this never turns out to be profitable for the stock investors. If you invest where everyone else is investing, the most likely situation is that you won't make much money from that stock. Many of the worst financial crises in the stock market like .com bubble or the economic recession of 2008 can be attributed to the same human tendency, that is herd mentality. And the final one is that no one knows the future. Yes, I repeat, no one knows the future, an ugly but honest truth about stock market. The top-notch analysts who keep guessing economic expansion or recession will fail to predict the same in a similar situation like 2008 when the market fell by around 60% will repeat. Advisors provide financial advice based on the available information and their past experience, but this information may change in future. If you expect them to predict the future, you are a fool, and if they predict the future, they are a fool too. When you are entering the stock market, be ready to see some unexpected things. As said earlier, no one knows the future. Always remember the famous quote by Warren Buffett. In the business world, the rear view mirror is always clearer than the windshield. That's all for this video. I hope it was useful to you. If you enjoyed it, please hit the like button and subscribe to this channel for more interesting investing videos. If you are new to the stock market, you can enroll to our 7-day free e-course on how to invest in Indian stock market. The link is given in the description. That's all. See you in the next video.